Those are all the top headlines that we are tracking from the world of commodities. But first up, let's put the spotlight on the kind of moves that we are seeing in the oil market. Brent crude today is sitting with a cut of nearly 0.8% after a 1.2% uptick that we saw in yesterday's trade, and it is now trading below that $68 per barrel mark. Now remember, broader markets across the globe and across asset classes are currently carrying a risk-off tone, and that is the reason we are seeing this kind of fall as far as oil prices are concerned. But remember, we have an important note that Goldman Sachs has come out with as far as oil market is concerned. They are saying that they expect Brent crude prices to decline to $50 per barrel by the end of 2026. They say that they expect oil surplus to widen, and it could perhaps average at 1.8 million barrels per day by the fourth quarter of 2025, resulting in a nearly 800 million barrel rise in global stock by the end of 2026. So some important commentary that Goldman Sachs has come out with, because of which oil prices are seeing a downtick, and of course on the back of several global factors which continue to remain at play for the oil market. But meanwhile, as far as gold is concerned, that too is sitting with a cut of 0.2% today. In fact, it has snapped its two-day gaining streak to fall below that $3,400 per ounce mark. But remember, we are seeing safe haven demand resume yet again. As far as the gold market is concerned, this after President Donald Trump again said that he is looking to fire Federal Reserve Governor Lisa Cook. So there are some questions with respect to independence of Federal Bank in the United States, and that is the reason safe haven demand seems to be resuming as far as the gold market is concerned. But let's keep it going with the yellow metal then, and BMI, which is a unit of Fitch Solutions, they've gone ahead and raised their 2025 annual average gold price forecast to $3,250 per ounce, up from $3,100 per ounce that they had earlier, citing resilience in the gold market. Their outlook for the remainder of this year remains neutral to slightly bullish, with prices expected to stay elevated ahead of an anticipated Federal Reserve rate cut later this year. However, the firm has also cautioned that much of the potential upside has already been priced in, limiting the scope for significant upside once Federal Reserve eases its policy in the meeting that is scheduled to happen over the next 2 to 3 months. To discuss this in greater detail, we are now joined by Sabrin Chowdhury, Head of Commodities at BMI. Mr. Chowdhury, thank you so much for taking your time out and joining us here on ET Now. We have seen volatile moves over the last few months. But Ms. Chowdhury, if you can tell us, what is the rationale of raising your target price as far as gold is concerned? And now that you've given a target price of $3,250 per ounce for the rest of this year, what are the key factors which will drive the upside for the rest of this year?
So gold prices are on their way to reach even higher levels in September in the coming month, and this is mainly going to be driven by the rate cut that we anticipate from the US Fed. Now, in the August Jackson Hole Symposium, Fed Chair Jerome Powell announced his decision to focus more on labor market risks, and this has led the market to price in a more aggressive pathway for interest rate cuts, and gold will definitely benefit from that. So safe haven demand has also risen in the past couple of months, as well as the interest in gold, which is a non-yielding asset. So the upside for gold is almost certain in the next couple of months. So we have revised our forecast upwards.
Okay, and what is the downside risk that you seeing as far as gold prices are concerned? If at all geopolitical concerns were to not escalate going forward, could gold prices fall in that scenario?
Yes, so in terms of geopolitical risks at the moment, there has been a very fragile ceasefire between the US-Israel attacks on Iran and Iran-Israel attacks. So on that front, it's pretty much stabilized for now, but we still see a very elusive possibility of ceasefire between Russia and Ukraine. So risks are still high at that point. So if you're talking about downside risks to gold, that is likely to come about if a ceasefire between Russia and Ukraine is declared, which still remains elusive as of now. The greater downside risk that could stem for gold prices is definitely if the US Fed decides not to cut in the September meeting. But the likelihood of that is very low, with the market probability of rate cutting in September rising to more than 80% in terms of probabilities. So most of the risks to gold prices right now are on the upside rather than the downside.
Was exactly my next question, Ms. Chaudhary, with respect to what you're penciling in from Federal Reserve in the meeting in September. I understand that the probability of a rate cut is on the higher side, but what after September have you penciled in to come out with this target of $3,250 per ounce as far as gold is concerned?
So gold prices have averaged around 3,150 in the year to date. We're anticipating prices to rise a little further. In terms of rate cuts, we expect the US Fed to cut rates by 25 basis points in September, and again by 25 basis points in December, and one more rate cut in 2026 by another 50 basis points. So with the cuts, we do expect an increase in the demand for gold, as yields will continue to ease in the coming months.
Okay, so that's as far as Fed move is concerned and what the impact will be on the yellow metal market going forward. Ms. Chaudhary, thank you so much for taking your time out and joining us here on ET Now and helping us with the rationale of why you have gone ahead and raised your target price on gold. Thanks so much for joining us today.